Most people think Washington is collapsing because politics has become dysfunctional, polarized, and incompetent. But that misses what is actually happening. The deeper reality is that dysfunction is no longer simply a failure of the system. In many ways, it has become part of the system itself. What looks like paralysis in public can still produce very clear outcomes in private. And those outcomes have often aligned less with the needs of citizens than with the needs of finance. So what does that actually mean? It means the real story is not that politics stopped working. It is that politics began working differently. Washington increasingly became a place where visible conflict distracted from invisible continuity. Administrations changed, parties traded power, public language became more hostile. But beneath that noise, one institutional pattern remained remarkably stable. When stress built up inside the American system, the final burden of adjustment rarely fell on concentrated financial power. It fell on households through inflation, on workers through stagnation, on the state through debt expansion, and on the political order through declining legitimacy. Wall Street did not need to control every decision in order to benefit. It only needed a system in which instability translated into dependence and dependence translated into influence. That system did not appear overnight. It was built over decades. After the Second World War, the United States developed a political economy in which industrial production, broad wage growth, regulated finance, and strategic state power were relatively balanced. Finance existed to support the productive economy, not dominate it. Banks were intermediaries. Capital markets were important, but they were not the central command system of national life. The state taxed, spent, regulated, and invested with a stronger sense that economic power had to serve political stability. But over time, that arrangement changed. Beginning in the late 20th century, financialization altered the structure of the economy. Profit increasingly shifted away from long-cycle productive investment and toward asset appreciation, leverage, trading, and debt engineering. Corporations discovered that financial optimization often generated faster returns than industrial expansion. Governments discovered that debt issuance was politically easier than structural reform. Households were drawn into the same logic through mortgages, retirement accounts, credit markets, and asset inflation. Step by step, finance stopped being a sector inside the economy and became the operating logic of the economy. Once that transition happened, Washington's role also changed. The capital was no longer simply managing national development. It was increasingly managing the conditions under which a finance-led system could keep functioning. That meant protecting liquidity, maintaining confidence in sovereign debt, stabilizing major institutions during crises, and preserving the legal and regulatory architecture that allowed large pools of capital to move, price, speculate, and consolidate. In that environment, political conflict could intensify without threatening the deeper structure. In fact, conflict could become useful. It kept public attention focused on personalities and elections, while the underlying machinery of debt, asset protection, and monetary intervention continued with striking consistency. This is how the system works. Washington produces the legal guarantees, fiscal backstops, and geopolitical umbrella. Wall Street prices risk, allocates capital, and converts political signals into market advantage. The Treasury market sits in between, linking the state to the financial system. The government borrows at enormous scale. Financial institutions hold, trade, and leverage those securities. The central bank stands behind the broader liquidity environment, and the global role of the dollar allows the United States to sustain levels of borrowing and market depth that would crush most other countries. It is not a loose collection of actors. It is an ecosystem of mutual dependence. That mutual dependence creates a powerful internal logic. When markets rise, political leaders claim success. When markets fall, pressure builds for intervention. When debt expands, Wall Street gains more instruments to trade, hedge, finance, and use as collateral. When instability spreads, large institutions become even more essential because they sit closest to the pipes of the system. The result is a structure in which disorder at the edges can strengthen control at the center. The system appears fragile, but its fragility also justifies the preservation of the actors already embedded within it. The scale of this system is difficult to fully grasp. The United States sits on a sovereign debt structure measured in the tens of trillions of dollars. Its treasury market is among the largest and most systemically important financial markets on Earth. Its equity markets dominate global capital allocation. Its banking system, shadow banking system, money market system, and derivatives infrastructure connect domestic political decisions to global asset pricing within minutes. A budget fight in Washington is not just a domestic event. A change in rate expectations does not just affect mortgages. A new sanctions regime is not merely foreign policy. Each move travels through balance sheets, collateral chains, reserve systems, pension funds, corporate borrowing costs, and sovereign calculations around the world. That is why the phrase "Washington is burning" is more than a metaphor. It captures a condition in which the political surface becomes increasingly unstable while the financial core becomes increasingly central. The more unpredictable politics becomes, the more everyone looks to markets for signals, to central institutions for rescue, and to large capital pools for continuity. This is not accidental. It is an emergent design. Wall Street did not need to write a single master plan in one room. It benefited from a much more durable mechanism, a structure in which every crisis made financial intermediation more necessary. But something has changed. For years, this model could survive because the costs were delayed, externalized, or hidden. Cheap money could soften contradictions. Globalization could suppress prices. Foreign demand for dollar assets could absorb American deficits. Asset inflation could create the appearance of wealth even when the real economy became more uneven. But the environment supporting that system is no longer as stable as it once was. Interest rates are no longer structurally near zero. Supply chains are more exposed to geopolitical conflict. Strategic rivalry has returned. Industrial policy is back. Debt servicing costs are rising. Social trust is weaker. And political institutions have less room to ask for sacrifice because legitimacy has already been drained. That shift matters because the old arrangement depended on timing. It could promise future growth to justify present imbalance. It could rely on financial expansion to postpone political reckoning. But once growth slows, rates rise, and external shocks become frequent, postponement becomes harder. The state must borrow more into a more expensive environment. Households must survive higher costs with weaker buffers. Corporations must refinance in a harsher cycle. Banks and funds must navigate an environment where liquidity is less abundant and volatility is more political. The system starts feeding stress back into itself. This is where the pressure network becomes visible. Economically, the United States carries high debt, asset dependence, regional inequality, and a development model that has favored capital concentration over broad resilience. Politically, it faces polarization, institutional mistrust, lobbying saturation, and a governing culture that often substitutes messaging for reform. Militarily, it remains committed to a global posture that is expensive, extensive, and increasingly tied to financial power through sanctions, reserve systems, energy routes, and alliance maintenance. These are not separate arenas. They intersect continuously. A more fragmented world pushes Washington to spend more on defense, industrial security, and strategic subsidies. Higher spending increases borrowing needs. Higher borrowing increases dependence on stable debt markets. Stable debt markets require confidence in policy continuity. But political instability undermines that confidence, which raises the premium on institutional intervention. That intervention, in turn, reinforces the centrality of the same financial actors already woven into the state's operating framework. At every stage, the solution reproduces the structure that created the vulnerability. These are not separate problems. They reinforce each other. When wages lag, but asset prices rise, wealth inequality widens. As inequality widens, political anger intensifies. As political anger intensifies, governance becomes more theatrical and less strategic. As governance weakens, long-term reform becomes harder. As reform becomes harder, policymakers rely more heavily on short-term stabilization through debt, liquidity, and market management. That pushes even more power toward financial institutions. And as finance becomes more central, the real economy becomes more subordinated to asset preservation. The cycle continues. That is the real meaning of the title. Wall Street planned Washington's fire, not necessarily in the narrow conspiratorial sense of scripting each scandal, vote, or crisis, but in the structural sense of shaping incentives over decades so that disorder would remain governable for capital. A system can be planned by architecture as much as by intention. If tax rules reward leverage, if regulation protects scale, if monetary responses consistently socialize downside risk, if lobbying ensures access, and if political fragmentation prevents deeper restructuring, then the outcome does not require perfect coordination. It requires only a repeated pattern. Over time, repeated pattern becomes design. From here, two broad paths emerge. The first is a gradual transition. In this scenario, American elites recognize that a system built primarily around financial expansion cannot indefinitely substitute for institutional renewal. The state begins rebalancing toward productive investment, infrastructure, energy resilience, industrial capacity, and broader income support. Finance remains powerful, but it is pushed back into a more bounded role. Debt is still high, but better growth composition makes it more manageable. Political conflict remains intense, but enough institutional competence is restored to prevent continual emergency rule by market signal. This is the stable path, not because it removes tension, but because it redistributes adjustment across the system instead of concentrating losses on the public and gains on financial incumbents. The second path is less orderly. In that outcome, Washington remains trapped in permanent spectacle while structural dependence on debt and asset inflation deepens. Each external shock then becomes more dangerous because the domestic buffer is thinner. A recession triggers aggressive intervention. An inflation spike limits that intervention. A geopolitical crisis raises spending while lowering efficiency. A funding conflict shakes confidence in governance. Capital flees risk, then demands rescue, then prices in political weakness. Under those conditions, the boundary between political crisis and financial crisis starts to disappear. Markets stop merely reacting to Washington and begin disciplining it in real time. The state then faces the classic trap of overstretched powers. It must project stability abroad while borrowing stability at home. That unstable path does not necessarily end in dramatic collapse. More often, systems like this decay through managed deterioration. Growth weakens, trust falls, emergency measures become normal. Elections change the language, but not the mechanisms. Citizens feel that nothing truly changes because, at the level that matters most, the operating code remains intact. In that environment, the greatest risk is not one spectacular event. It is the normalization of permanent fragility. And that leads to the deeper conclusion. This is not just about Washington. It is not just about Wall Street. It is about what happens when finance ceases to be a tool of national power and becomes the grammar through which national power is exercised. Once that happens, every political crisis is filtered through asset values. Every strategic decision is entangled with debt management, and every reform is constrained by the need to preserve confidence inside markets that have become too central to challenge directly. The real question then is not whether Washington is burning. It is whether the fire is still contained within politics or whether it has already reached the foundations of the system that made American power possible in the first place. Because when a society begins organizing itself around the stabilization of instruments rather than the renewal of institutions, it may still look wealthy, it may still look strong, and it may still look governable for a while. But beneath that appearance, the balance between state, market, and society has already started to break. And once that balance breaks, the issue is no longer who controls the system. The issue is whether the system can still control the consequences of what it was built to reward.